The Philippine Central Bank just raised interest rates as inflation fears soar due to the Mideast war. How could a conflict thousands of miles away hit your wallet now? Inflation in the Philippines has been under pressure with the ongoing conflict in the Middle East disrupting global oil supplies and commodity prices. The Philippine Central Bank responded by increasing interest rates to slow inflation growth. This move aims to stabilize prices by making borrowing more expensive and cooling demand in the economy. The war's impact on fuel costs is a key driver behind this inflation risk, affecting everything from transportation to food prices across the country. By raising rates, the central bank intends to protect the Philippine economy from overheating. Higher borrowing costs can reduce consumer spending and business investments, which helps to ease inflationary pressures. In the current climate, with energy prices spiking due to Mideast instability, this tool is essential to prevent inflation from spiraling out of control. It also signals the bank's commitment to maintaining economic stability despite external shocks. Though geographically distant, the Mideast war is sending shockwaves through global markets, particularly in oil. The Philippines, a net importer of fuel, faces higher import costs that translate directly into increased prices for consumers. Transport, manufacturing, and agriculture sectors feel this squeeze, driving inflation higher. This interconnectedness exemplifies how international conflicts can rapidly impact local economies and everyday prices. For Filipino households, the central bank's rate hike means higher loan interest payments on mortgages and personal loans. Meanwhile, rising inflation cuts into purchasing power, making essentials like food and fuel more expensive. Businesses also face higher costs, which may lead to slower hiring or price increases. This creates a challenging environment for families trying to manage budgets amid global uncertainty. The Philippine Central Bank's decision signals an expectation that inflationary pressures could persist as the Mideast conflict continues. Policymakers remain vigilant, balancing the need to support growth while preventing runaway inflation. Future rate adjustments will depend on global developments and domestic economic data. For now, the bank's move is a preemptive strike to safeguard economic stability. What this means for you is that everyday costs could rise and loans might get pricier. Staying informed helps you plan your finances wisely during these uncertain times. If you want to stay ahead of how global events impact your money, subscribe and hit the bell so you never miss an update.